On June 2nd, 2022, Coinbase deployed a service that scanned the Bitcoin blockchain for addresses that had done nothing for 5 years or more. 1.3 million of them in the first 12 months alone received an email. You might think this was routine maintenance, find the lost, wake the dormant, recover the asset. But the engineers who built that service noticed something they could not explain. When those wallets woke up, most of them moved funds not to personal wallets, not to hardware devices, but to exchange deposit addresses. Within 30 days of receiving that email, a significant fraction of those owners generated new exchange API keys. The dormant wallet was not a storage unit, it was a trigger, and that changed everything the quants thought they knew about user behavior. Here's what the models assumed. A wallet that has been silent for 5 years belongs to someone who forgot about it, lost the key, or is holding for a long-term cycle. The probability of reactivation in any given month is near zero. The probability that the reactivation leads to new exchange activity within a month is even lower. But Coinbase's data, internal to the Dormant Asset Recovery Program, showed the opposite. 13% of reactivated wallets generated new API keys within 30 days. That number was high enough to break every behavioral model the exchange had built. The engineers sat back and stared at the screen. You have felt this moment, the moment when data contradicts a model you trusted, the moment your screen shows a signal that cannot exist, but it is there, blinking, refusing to disappear. You refresh, it stays. You check the source code, no bug. The model was wrong. The gap between what the model predicted and what the data showed was not noise. It was information. The quants had one assumption. They believed that dormancy was a proxy for abandonment. A wallet that does not move for 5 years might as well be empty. But the data from Coinbase's API logs told a different story. The dormant wallet was not abandoned. It was waiting for a specific trigger, a notification, a regulatory change, a price event, a security breach. And when that trigger appeared, the owner reactivated the wallet with a speed and precision that no algorithm could have predicted. The model could not simulate patience because patience is not a variable they could code. Now watch what happens when a machine trained on millions of data points meets a behavior it cannot model. It freezes. The exchange's risk algorithms, designed to flag suspicious activity based on velocity, volume, and deviation from historical patterns, had no rule for a wallet that did nothing for 5 years and then executed a single perfect transaction. The flags did not trigger. The alerts did not fire. The wallet walked through the gap. Remember that word, gap, because it is coming back. You see that gap now. It is not a flaw in the code. It is a flaw in the assumption. Subscribe to this channel if you want to keep finding the gaps the quants refuse to see. And in the comments, type the one word that explains why the wallet walked through, gap. In January 2023, Chainalysis published its annual crypto crime report. The headline was a 45% year-over-year increase in transaction volume from wallets that had been inactive for 12 months or more. The report attributed the surge to post-pandemic liquidity seeking and the migration of illicit actors. But buried in the appendix was a detail the quants could not explain. The wallets that reactivated after 12 months of dormancy had an average transaction value that was 2.3 times higher than the average transaction of continuously active wallets. The dormant wallets, when they moved big. They did not test the waters. They executed. The institution's explanation was predictable. They called it anomaly. They called it outlier. They called it survivorship bias. Each explanation was weaker than the last. You have experienced this, when every explanation for a pattern you observe feels like a rationalization until you realize the rationalization is their framework, not your observation. The data did not lie. The model was wrong. If this level of detail matters to you, if you are the kind of trader who wants to understand why wallets move, not just when they move, you are in the right place. In April 2023, TRM Labs released a report that quantified the scale. $158 billion of digital tokens were transferred to wallets flagged as criminal during that year, a 145% increase over 2022. And approximately 30% of those flows originated from wallets that had been dormant for more than 12 months before the transfer. The dormant wallet, in the analytics firm's language, was a sleeping account, a holding vessel that appeared inert until the moment it was needed. The model could not see it because the model was trained to look for activity. The dormant wallet had none, but here's where it gets worse. The 30% figure was not evenly distributed. In specific categories of illicit flow, ransomware payments, darknet market transactions, exchange hacks, the proportion of dormant to active transfers exceeded 50%. The attackers were not using fresh wallets. They were waking old ones. And the exchange APIs designed to flag new addresses with no history had no rule for an old address with perfect history that suddenly became active. The U.S. Federal Bureau of Investigation's Internet Crime Report for 2023 documented 69,000 public complaints involving cryptocurrency fraud, representing approximately $5.6 billion in losses. The report noted that a notable proportion of these complaints stemmed from victims whose crypto was stolen from dormant wallets that were compromised after being linked to exchange APIs. The mechanism was simple. An attacker harvests an exchange API key through phishing, credential stuffing, or crypto stealer malware. The API key is linked to a wallet that has been dormant for months or years. The wallet has a balance the attacker knows from a previous scan. The attacker waits. The wallet is a sleeping trigger. When the owner reactivates it to send funds, to trade, to withdraw, the API key is already compromised. The transaction that wakes the wallet is the same transaction that drains it. And the exchange's risk algorithm, watching for rapid withdrawals, large deviations from historical behavior, and first-time transfers to unknown addresses, sees nothing abnormal. The wallet had no history of suspicious activity. The API key had no history of abuse. The transaction fit every parameter of a normal transfer. The attacker, sitting in a rented apartment with a compromised terminal, executed a transfer that the algorithm could not flag because the wallet's dormancy had erased its risk profile. In July 2023, Binance's API monitoring team deployed a new endpoint called Wallet Activity Alert, WAA for short. The endpoint triggered whenever a wallet that had been silent for more than 180 days initiated a transaction. In the first quarter of deployment, approximately 2.4 million alerts were generated. Of those, approximately 12%, approximately 288,000 alerts, were linked to exchange deposit addresses, wallets that had been silent for 6 months suddenly sending funds to Binance. The quants at Binance had a problem. The WAA alerts were not false positives. They were real. But the model could not distinguish between a legitimate reactivation, an owner waking a wallet to fund a trade, and a compromise, an attacker waking a wallet to liquidate a stolen balance. The model had no signal for intent. It could only measure velocity, volume, and deviation. The dormant wallet had none of those. The team sat back and stared at the alert queue. The alerts kept coming. You have felt this tension. The moment your model produces an output that is technically correct, but operationally useless, you have the signal. You cannot interpret it. The quants at Binance could see the reactivations. They could count them. They could timestamp them, but they could not stop them. Now here is the part that made the engineers at Etherscan sit back in silence. In February 2024, Etherscan launched its own version, the Inactive Address Watch API, or IAW API. It flagged Ethereum addresses with 0 outbound transactions for more than 365 days. By the second quarter of that year, the IAW API had logged approximately 3.1 million wake-up events. Approximately 18%, approximately 558,000 events, match known exchange hot wallet prefixes. Kraken, Coinbase, Binance, the same pattern across 2 blockchains. The engineers expected a small number of reactivations. They expected dust movements, small test transactions from wallets waking after years of silence. What they found was the opposite. The average transaction value for IAW-flagged wallets was 4.7 times higher than the average transaction of continuously active wallets. When a dormant wallet woke, it moved a significant portion of its balance. It did not test, it executed. And here is the detail that shattered the model. The reactivations did not follow a random distribution. They clustered around specific events, exchange announcements, regulatory changes, price movements. The wallet was not waking spontaneously. It was waking in response to a trigger the institution had created. The exchange's own announcement was the signal that woke the wallet. The quants called it confirmation bias. The data called it a pattern. The quiet ones watching the noise. That is who we are. If you have already felt that you see something the models cannot, make it official. Link in the description. In September 2024, ESET's threat report for the second half of that year documented a 56% increase in crypto stealer detections from the first half to the second half of the year. The report correlated the spike with a surge in wake-up activity from dormant wallets. The attackers were not finding new victims. They were rediscovering old ones. Wallets that had been scanned years earlier, their balances recorded in a database, were now waking and sending funds to exchange APIs. The attacker, who had the compromised API key from a previous breach, was waiting. The mechanism was recursive. The crypto stealer harvested the API key. The key was linked to a dormant wallet. The wallet had no activity for months or years. The attacker stored the key and waited. When the wallet woke, triggered by an exchange email, a price movement, a regulation change, the attacker executed the transfer within minutes of the first transaction. The exchange's risk algorithm, watching the waking wallet's first transaction, had no history of the API key compromise. The attacker was invisible, and the number keeps climbing. In December 2024, Gemini's Security Insights white paper revealed that approximately 41% of all newly registered exchange API keys in 2024 were generated after a dormant wallet address performed its first transaction in the preceding 30 days. The correlation was not coincidence. The dormant wallet waking was the precursor to the API key generation. The quants at Gemini could not model this. Their user behavior models assumed a linear progression: create account, generate API key, fund wallet, trade. The data showed a recursive loop: fund dormant wallet, wake wallet, generate API key, trade, repeat. The model could not simulate a loop that began years before the account creation. Here is the core paradox. The institution's detection systems were designed to flag new behavior, new wallets, new IP addresses, new deposit addresses. But the dormant wallet did not look new. It looked old. It had history. It had a clean record. It had been invisible for so long that the model had forgotten it existed. The model assumed that dormancy was a sign of absence. The data showed it was a sign of waiting. The question is not whether the system can detect the waking wallet. The question is whether the system knows what to do when the wallet wakes. Because the answer, the one the quants at Binance, Etherscan, and Gemini are still searching for, is not in the data. It is in the moment the wallet owner decides to move. You are that moment. The waking wallet is just a trigger. You are the decision, and the model cannot simulate you. The model cannot simulate you because you are not a variable. You are the one choosing when to move. Subscribe to stay inside the room where the decisions are made. And in the comments, write the word that separates the trader from the data. Write decision. One thread remains open: the identity of the attacker who harvests the API key, who waits months or years, who executes the transfer at the exact moment the wallet wakes. Why they wait, what they see that the institution cannot. That answer changes everything you think you know about who wins in this market. The next chapter of this story goes deeper into the specific conditions the attacker exploits. The windows between the wallet waking and the exchange's model updating. That is where the real edge lives. But there is another layer the security research team never published. A pattern in the wake-up events that contradicted everything they believed about risk management. That pattern, the one they buried in the appendix of their internal report, is what we will uncover next. So the next time you see a wallet with 5 years of silence, do not ignore it. Do not assume it is empty. Do not assume it is forgotten. That wallet is a trigger waiting to be pulled. The question is, who pulls it first? The owner or the attacker? Subscribe now. Learn to see the triggers before they fire. The researcher who studied those wake-up events, a cryptographer at MIT's Digital Currency Initiative, published a working paper in January of this year. She examined approximately 4,700 wake events from wallets that had been silent for between 3 and 8 years. The transaction patterns she found were not random. They followed a behavioral profile that matched neither organic user reactivation nor automated compromise. The transactions happened in batches, 3 to 7 transfers within a 6-hour window, and then the wallet went silent again. The attacker or owner, whichever it was, executed their objective and then re-entered dormancy. The wallet was not moving to a new home. It was executing a single task and returning to storage. The researcher called them trigger wallets. Wallets that existed not as living accounts, but as inert instructions waiting for a specific condition. The condition in most cases was an external event the wallet owner could not control, a price crossing a threshold, a regulatory announcement, a protocol upgrade, an exchange API deprecation. The wallet was not a tool for daily trading. It was a weaponized instruction set stored in the chain, invisible until its moment arrived, and the institution's entire detection framework had no rule for a weapon that only fires once. The researcher's paper included a detail that the exchange security teams refused to publish. Of the 4,700 trigger wallets she identified, approximately 62% had been funded from an exchange hot wallet, not from a personal wallet, not from a mining pool, not from a peer-to-peer transfer. The funding came from the same type of institution that would later try to detect the wake event. The exchange had seeded its own blind spot. The wallet was born inside the system it would later exploit. The cryptographer traced the funding transactions. They followed a pattern, a single deposit from an exchange hot wallet to a fresh address. The address would receive 1 or 2 small test transactions over the next week, then go silent for years. When the wallet woke, it did not return the funds to the same exchange. It sent them to a different exchange, one where the owner had generated API keys months before the wake event, linking the dormant wallet to a new identity the original exchange could not trace. The trigger wallet was not dormant. It was a bridge between 2 identities waiting for the right moment to connect them. You have felt this pattern before. The transaction that looks clean, the wallet that looks old, the address that has never been flagged. And then the move, executed at the exact moment the model predicted nothing would happen. The system saw the pieces. It could not see the gap between them. In March of this year, the Financial Crimes Enforcement Network, FinCEN, issued an alert regarding the use of dormant wallets and layering transactions. Layering is the process of moving illicit funds through multiple addresses to obscure the source. Traditionally, layering happens fast, rapid transfers, multiple hops, temporal compression. But FinCEN identified a new variant they called sleep layering. In sleep layering, the funds sit in a dormant wallet for months or years between hops. The temporal gap between transfers is so large that standard detection algorithms, which flag clusters of rapid transactions, see nothing. The layering is invisible because it happens at a speed the model does not monitor. The alert noted that sleep layering had been observed in connection with approximately $1.2 billion in suspicious transaction volume during the previous 18 months. The method was not new, but the scale was. The dormant wallet in sleep layering is not a storage unit. It is a time machine. The attacker moves funds into a wallet, waits until the exchange's risk model has forgotten the initial transfer, and then moves the funds out. The temporal distance between the 2 legs of the layering transaction is the attacker's camouflage. The model can trace the first leg, it can trace the second leg, but it cannot see that the 2 legs are connected because the pause between them exceeds the model's look-back window. And the look-back window is the key. Most exchange risk algorithms scan a maximum of 180 days of transaction history for a wallet's behavior. If a wallet has been dormant for more than 180 days, it enters a state the model treats as clean history. The wallet's prior transactions are not considered relevant to its current behavior. The attacker knows this. The attacker waits 181 days before executing the second leg. The model sees a fresh wallet with a single clean transaction. It has no memory of the first leg. The cryptographer at MIT found that the average pause between funding and execution in her trigger wallet sample was 412 days, well beyond the standard look-back window. The attacker was not exploiting a bug. They were exploiting the model's definition of clean. The model assumed that time erases risk. The data showed that time only stores it. The quants called it a temporal gap. The attacker called it a waiting game. Now here is the part that made the Ethereum Foundation's security team pause. In April of this year, they published an analysis of a single trigger wallet that had been dormant for 2,197 days, just over 6 years. The wallet received funds on June 3, 2018. 2,197 days later, on June 4, 2024, the wallet executed a single transaction that moved 97% of its balance to an address linked to a decentralized exchange routing contract. The transaction was not flagged by any major exchange's risk system because the wallet had no on-chain activity for 6 years. The look-back window had reset multiple times. The wallet was invisible. The wallet owner, whoever they were, had funded a cold wallet in 2018, waded through an entire market cycle, waded through the crash of 2022, waded through the recovery of 2023, and executed exactly 1 day after the transaction timing aligned with their plan. The execution did not require speed, it required patience. And the institution's models were not designed to detect patience. The security team's report used the phrase extreme temporal patience to describe the behavior. They could not determine whether the wallet owner was a trader executing a long-term strategy, a victim who had lost access and regained it 6 years later, or an attacker executing a pre-planned layering cycle. The wallet gave no signal. It simply existed, then moved, then fell silent again. The cryptographer in her working paper proposed a new detection method. She called it temporal fingerprinting, scanning the chain for wallets whose funding and execution transactions are separated by more than the standard deviation of their user class. A wallet funded from an exchange hot wallet that waits more than 365 days to execute is not a normal user. A normal user either trades within weeks or forgets the wallet entirely. A trigger wallet waits long enough for the model to forget the funding source. The waiting itself is the signal. The paper showed that temporal fingerprinting would have flagged approximately 34% of the 4,700 trigger wallets in her sample. The false positive rate was approximately 11%. The method was not perfect, but it was the only method that looked at the one behavior the attacker could not fake: the time they spent waiting. The exchange security teams reviewed the paper. They acknowledged the findings. They did not implement the method. The reason, according to internal correspondence the cryptographer obtained through a public records request, was that temporal fingerprinting would require maintaining transaction history for wallets beyond the current look-back window, a cost they deemed unacceptable. The model could detect the trigger wallets, but the infrastructure to do so was more expensive than the losses the trigger wallets caused. The engineers called it a cost-benefit analysis. The cryptographer called it a blind spot by design. They made the blind spot on purpose. That is not negligence. That is design. Subscribe now because the next layer of this investigation reveals the exact appendix they buried. And in the comments, type blind spot. Tell me if you think the cost-benefit analysis was worth it. And this is where the story turns. Because the real secret is not the trigger wallet. The real secret is what the trigger wallet taught the institution about itself. They knew the wallet existed. They knew the wallet would wake. They chose not to watch it because the cost of watching was higher than the cost of the wake. The institution's blind spot was not a failure of detection. It was a failure of priority. They could have built the system to see the dormant wallet. They chose not to. And every wallet that wakes in the gap is a reminder that the model's most expensive blind spot is the one it created on purpose.